So it's morning at 6:45 as we get this Thursday edition, this pre-Friday Eve edition, and just, man, can we just get this week over with? That's what people are saying right now. Can we just stop? Everybody take a breath.
Feels like Saturday already.
I know, right?
It's only Thursday.
Everybody take a breath here in the markets for just a minute. Let's talk about two things here as we wrap up the show. First is this idea of, more QE, right? There's a real probability, and I put a tweet out this morning. I said, headline from the future, March 18th, Fed cuts interest rates to zero, launches a $2 trillion quantitative easing program. The response from the Fed is almost pretty predictable at this point. But the problem becomes is that, more liquidity at this point could become very inflationary. And that's something you've been talking about here for a while, and I wanted to discuss that with you real quick.
Yeah, so there's a few aspects of it. So right now we're getting hit with deflation pretty hard, right? Mm-hmm. We're not, you see it in commodities. Price of oil is down sharply, and many other commodities are down a lot. And my guess is the initial price reaction to everything going on will be lower prices. But you have the Fed and every other central bank pumping money into the markets. You have more fiscal stimulus coming. I mean, it's very likely the U.S. deficit this year could be $2 trillion, mm-hmm. right? If they do any sort of tax break or any sort of bailout, we're looking at $1.5 to $2.5 trillion deficit. So you have all this massive stimulus thrown at the markets, at the economy. And this virus will work its way out, right? South Korea and China are already on the mend. So, we got another month or two, and it's going to be tough. I'm not saying it's easy, but this will work its way through, and the stimulus is going to be out there. And if we know anything about the Fed, they're really slow to take it back.
Right.
And the government can't take back fiscal stimulus, right?
Right.
So this stimulus will be, can you ever see a day where the Fed says we're going to raise rates 150 basis points? No.
No, I have a feeling once they get to zero, they're going to stay there for another several years.
Right. Yeah. Or do it so slowly, like watching paint dry. So that's one aspect of it, right? You got a massive influx of money chasing the economy when the economy is healing pretty rapidly. At the same time, you have, I think, nationalization will become even stronger. A lot of countries are going to ask themselves, why was for America, why are we relying on China for 80% of our pharmaceuticals? That's just insane. Mm-hmm. So I think a lot of countries and companies are going to diversify where they make their products and where they import their products from. Doesn't mean it's coming back to the U.S., but maybe pharmaceuticals will move to 4 other countries so that it'll be 20%, in mm-hmm. 4 countries.
Right.
The problem with it is that most companies seek out the cheapest source of goods for their imports, right? They mm-hmm. want to make as much money as they can.
Well, and labor's the key input to that.
Right. So by default, if they have to find 2 or 3 or 4 other places to make their products, they're all going to be more expensive.
Mm-hmm. Right. And again, that comes back through pricing and comes back into the other issues. And, and again, the Federal Reserve, Jerome Powell made it very clear last year. He said, he made statements. He said, we're not going to raise rates until we see sustained levels of higher inflation. And so they're willing to let the inflation numbers run hot for quite some time before they even consider raising rates. So if they do go to zero at the next meeting and do QE, to your point, they're probably going to stay there for an exceptionally long period of time. So we could see inflation spike up rather sharply without a Fed response, because the Fed's going to be concerned if they start hiking rates, it just causes another problem. And so everybody's going to be slow to react.
Right. And we're going to hear the word transitory. Right. It's deflation and inflation will be transitory. It's related to the virus. It's not going to last long, and we're going to get back to our normal inflation rate. Well, that's not necessarily the case unless, the Fed and the government pull that money back as quickly as they put it in, which right. I have doubts, to say the least.
Well, so let's talk about what's really important to people this morning is, what should they be doing with their portfolios? Look, we've had a very, very sharp decline here. There's not been more than a one-day bounce in a row at this point, really, for investors to do much of anything. So from, kind of your perspective here, where we are, we're just actually clipped yesterday. It's hard to believe, but in just 3 weeks, we went from an all-time high to actually launching into an official bear market. A 20% decline technically, measures as a start of a bear market. That happened yesterday at the close. What should investors do now?
I think you need to get to a level that's comfortable, that you can say, what if, and I'm not saying this is going to happen, but what if the market were to fall significantly from here? Mm-hmm. What's a level of losses that I'm willing to take from here? And, get to that level or get to a level near it and just sit on your hands, because this is a tough market to trade. It's a tough market to understand what's going on, because now the fear has become more personal. Mm-hmm. We hear about our local school districts. We hear about the NBA shutting down. I'm sure most people at this point now know of someone or someone's friend that has the virus. So it's becoming a lot more personal, and our spending decisions are rapidly changing to be much more conservative, right?
Right.
We're going out less. The thought of just going out to dinner now doesn't excite me anymore, right? There's a lot of things that, we're going to watch some Netflix. We actually watched a new show on Amazon last night that's a long series. So just kind of hunker down. It's kind of like a snowstorm. When we get those big, blizzards here, you're hunkered down for 3, 4, 5 days.
Right.
And unfortunately, that's what this is going to be like. So you got to do the same in your portfolio. Get to a level of comfort and hunker down. And look, the Fed's going to try to be active. The Fed's going to try to move markets. They may be able to push the markets higher. Great. They may be unsuccessful. This market rests on trust in the Federal Reserve. And if the Fed can't deliver, there's potentially a lot more downside. So.
Yeah. And that's absolutely true. And the risk and the problem is that you don't know where you are right now. And this is kind of the big problem, is that the markets are very oversold here on a short-term basis. We just put out a report this morning that's going through some of the analysis on our website. But, the markets are very oversold short term. Theoretically, it's funny because just 4 weeks ago on the show, we're talking about the markets being 3 standard deviations overbought. Now you're 3 standard deviations oversold. And, this is where normally you would expect to see the markets get some type of reflexive action, just from the standpoint you've kind of stretched rubber band as far as you can in the other direction now. And it's interesting in just how quickly that reversion happened, because again, just 3-4 weeks ago, we're talking about, we've stretched the rubber band as far as we can in one direction to the upside. It's going to snap back, and here we are already, in the other direction. It happened so quick. It really took a lot of investors by surprise. And this is where investors kind of start to panic. It's like, man, I'm just gonna bail out right here. I just got to get out of this, and that typically turns out to be a mistake. Not having some type of controlled strategy to just reduce risk and use opportunities.
Right. So a couple of things. Fear is much more powerful than greed as far as the markets go.
Yeah.
Right. So downside can be much more powerful than the upside. And we put out that article yesterday about a process. All these passive investors don't have a process. The process is just buy the market and watch. You have to have a process. Whatever that process is, that will help you establish areas where you sell, where you acknowledge risk, where you're basically sitting some degree on the sidelines. And just consider having a process. Even if you start that process today, have a process, have a set of rules in place that you will follow regardless of what your emotions are telling you.
Well, this is always the problem with passive investing, which is, everybody's, when markets are rising, passive investing is easy. It sounds like a great plan. Last year we were writing articles about the FIRE movement, right? Which is the financial independence, retire early. And of course, you're banking on annual rates of return of, 6, 7, 8%, your money to grow. But a lot of that FIRE movement never started prior to a bear market before. So this type of action in the market kind of throws all those plans out the window. Right. And because that fear that sets in, people go, I can't, I know I'm supposed to just ride this out and not worry about it. But I'm worried about it, right? It's my money. And, on the downside, people worry a whole lot more about their money than they do when markets are rising. And, this is where, again, moving quickly and not really thinking about what you're doing, this is where you wind up in problems of, selling bottoms and not getting back in. And again, it's okay to sell here, but just remember you also have to get back in at some point when this does pass. And again, if you want to sell out today, hey, that's fine. We're likely going to go lower over the course of the next few days. There's a real probability we're going to retest the 2018 lows. But you just have to also be ready to buy back in when that occurs. It's going to feel terrible when you start buying, but that's when you've got to start to do it.
All right. And there's actually where a value is finally being uncovered. We see things that look good now, right, that are very cheap. And it's the first time we've seen that in a few years.
And they get cheaper.
Right. It probably will get cheaper. But, you can't just sit on your hands and do nothing either, unless you're willing to sit for 20 or 30 years.
Right.
So be comfortable, have a position that works with you, that allows you to sleep at night, and manage risk carefully. And the other problem, Lance, real quick, is that Treasury bonds are so low in yield that they can't provide the protection they have in years past.
Well, that's the other problem for investors now is, where do you go to hedge risk, right? Bonds have been a great hedge for us, up to this point. But as we talked about earlier in the show today, and as you just mentioned, there's not really an ability for rates to drop fast enough for those bonds to actually provide the same hedge they were providing before. So, what do investors do now?
Right. And gold has the last couple of days been trading weaker, probably because foreign governments have to sell it to raise money. I saw Bitcoin, which I don't really subscribe to Bitcoin, but Bitcoin is down, I think, 10 or 15% today.
Right.
So any perceived hedge, whether it's crypto, gold, or bonds, has just not been working the last couple of days. Cash is king, as they say, Lance.
Wait, didn't Ray Dalio just tell us that cash was trash, like at Davos just recently?
Yeah. He's 0-2 now with his cash quotes.
There you go. All right, Mike. Well, thanks a lot. We appreciate you, sir. Yep. We'll catch back up with you next week. And in the meantime, get by the website, realinvestmentadvice.com. Send us your questions, comments, emails. We're happy to help you out. We have an article out this morning talking specifically, it's a special report on where we are. On a daily basis, markets are very, very oversold. And so while, it feels terrible right now, what's happening, be careful here, because we're likely going to get some type of hope in the markets, right? Markets, have moved very quickly in one direction. You're likely to get a 1 or 2 day bounce here to sell into at a better price, but you may be selling it where you were yesterday. That's the problem with where we are in the markets. But longer term, there are definitely changes to what's happening with the tone and tenor of the bull market that started in 2009, that it has officially now come to an end. And what does that mean? That's all on the website today in the article. And if you have any questions or comments about it, be sure and email us. Let us know what we can do for you. realinvestmentadvice.com. I'm your host, Lance Roberts. Have a great day. It's a rich man's world. It's a rich man's world.